Something happened in the silver market today that a lot of people watching their portfolios are not fully processing yet. And if you're in precious metals right now, if you've been paying attention to what gold and silver have been doing over the past several weeks, what I'm about to break down for you over the next 10 minutes could genuinely change how you think about where you stand. Because right now, two completely different signals are coming out of the same market at the same time. And depending on which one you listen to, you'll either be preparing to exit or preparing to position. So before you do anything with your money, hear this out completely. Silver just took one of the hardest single session hits it has seen in recent memory. We're talking about a move that started above $96 per ounce during the Asian and European trading sessions and fell all the way down to around $87.66 by the time this was being put together. That is a loss of roughly 6.33% in a single trading day. And that number doesn't sit in isolation. That decline comes on top of a broader drop of 37% from the highs we saw at the end of January. In just over a week, silver gave back more than a third of its value from peak to trough. If you're holding silver, or if you've been watching from the sidelines thinking about when to get in, that 37% number lands very differently depending on whether you understand what's actually driving it and what it means for what comes next. Before we go any deeper, if this kind of analysis is what you've been looking for, something that doesn't push you toward a paid membership or trading course, something that just breaks down what institutional and professional money is actually looking at in plain language, then hit the subscribe button right now. Element Axis exists to give you exactly that. Every single video on this channel is built around one goal: taking the information that professional analysts and institutional traders work with every day and explaining it in a way that a serious, thoughtful investor can actually use. No hype, no sales pitch, no agenda behind the analysis, just the data and the context around it. If you're new here, you're going to want to be around for what comes next in these markets. Now, let's get into it. The first major piece of this story comes from a research report just released by one of the most respected names in the global precious metals industry. We're talking about one of the largest physical precious metals refiners operating anywhere in the world. Their message is direct and doesn't leave much room for interpretation. Gold and silver likely have further to fall before they reach their price floor. That's the headline conclusion from an institution that works with more physical precious metals on a daily basis than most investors will ever see in a lifetime. One of the most credible voices in the actual physical metals business is telling you the bottom is not in yet. And the reasoning they lay out goes back across multiple cycles and multiple decades. The comparisons they're drawing are to two of the most dramatic precious metals rallies in modern financial history. The first is 1980. The second is 2011. Both of those years saw silver climb toward and in some cases above the $50 per ounce level, driven by extraordinary combinations of monetary uncertainty, geopolitical stress, and speculative momentum that built on itself as more participants chased the rally higher. Both of those situations ended the same way. The price peaked, reversed, and then declined over months and in some cases years in ways that erased enormous percentages of the gains. The research puts the range of potential decline from an extreme rally at somewhere between 40 and 70%. When you're already down 37% from the January high, and the most credible voice in physical precious metals refining is saying that previous cycles in similar situations took much longer and went much lower before finding a floor, you can understand why some investors are seriously reassessing their positions right now. The report gets specific about the price behavior we've seen. After the initial sharp drop from the January peak, silver bounced and recovered to what analysts call the 50% retracement level. That means the price came back up and gave back roughly half of what it had lost before running out of momentum. Gold performed better during its recovery, retracing approximately 70% of its decline from the highs. That gap in recovery strength between gold and silver is not a minor detail. It's a signal about where institutional conviction is actually sitting. When silver underperforms gold during a recovery from a sharp correction, it historically indicates that the heavier selling pressure and the weaker hands are concentrated in silver rather than in gold. The research is using that underperformance as part of its case for why silver may need to go lower before it can sustain a real move higher. Now here is the single most important thing I'm going to say today. And I need you to stay with me on this because it reframes everything else. The same research report warning about further downside also states explicitly that the fundamental reasons for owning gold and silver have not changed since January. Read that again. The fundamentals have not changed. Not the supply dynamics, not the monetary demand drivers, not the geopolitical backdrop, not the long-term industrial demand picture for silver. What changed was the pace of the move higher. What changed was the positioning that built up during the extraordinary rally through 2025 and into January. What changed was sentiment. The collective psychology of investors that swung to levels of optimism that historically precede sharp corrections. The research is not saying gold and silver are broken investments. It is saying they ran too far, too fast, and the market needs time and lower prices to wash out that excess optimism before the next genuine phase can begin. This distinction is not academic. It is the difference between a structural problem and a cyclical reset. A structural problem means the underlying case for owning the asset is compromised. Something fundamental has changed that makes the investment thesis invalid going forward. A cyclical reset means the asset moved too fast in the short term, built up excess speculation and leverage, and now needs to digest that before the structural drivers can reassert themselves. The institutional research here is clearly describing the second scenario, not the first. And if you internalize that difference, you will approach the current market environment in a fundamentally different way than someone who reads the headline, feels the fear, and reacts from that place. Now let's go to the other side of this story, because if I only gave you the bearish case, I would not be doing this properly. There is a counter-narrative developing right now in the physical market, and it deserves exactly as much attention as the institutional warning. Because while research notes are talking about further downside in the paper market, what's actually happening in the physical spot market in Shanghai is telling a different story entirely. Despite the paper price retreating sharply from recent highs, despite the bearish momentum in the futures market, the downstream buyers in Shanghai are actively inquiring about and actively purchasing physical silver on this dip. When I say downstream buyers, I need you to be clear on exactly who we're talking about. These are not speculators. These are not traders placing directional bets on where silver closes next week. These are manufacturers. These are the companies that produce solar panels, that build semiconductors, that manufacture electric vehicles, that make the consumer electronics that go into tens of millions of homes. They have production schedules. They have supply requirements their customers are counting on. They cannot simply sit on the sidelines indefinitely because the paper futures market is in a bearish phase. They need the physical metal to make real things. And right now, they are buying. The Shanghai data also includes something not getting nearly enough attention in the broader coverage of this sell-off. Some suppliers in the physical spot market have seen their inventories drop to just 2 to 3 metric tons. Think about that number in the context of a global industrial metal market. 2 to 3 metric tons is not a market overflowing with supply, desperately trying to find a buyer at any price because the futures chart looks ugly. That is a genuinely tight physical supply situation, and some of those suppliers are actually holding back, reluctant to sell at current prices, because they understand something the paper market may not be fully reflecting. The premium negotiations happening in Shanghai right now are showing that while premiums have adjusted somewhat, they are still sitting at elevated levels relative to historical norms. The physical market has its own internal logic, and right now that logic is not aligned with what's happening in the paper futures market. If you're finding this breakdown useful, hit the like button right now. It genuinely matters for reaching more people who are trying to think clearly through what's happening in these markets instead of just reacting to headlines. Drop a comment below and tell me where you're watching from. Element Axis reaches viewers across the United States, but also into Canada, the UK, Australia, and far beyond. And if you know someone sitting on a metals position right now trying to figure out what to do, share this video with them before they make a decision they might regret. Let's talk about the ETF picture, because this is a third data stream that deserves serious consideration. The same report that warned about further downside actually acknowledged this data, and the numbers are significant. Global silver ETF holdings rose by more than 18 million ounces in a single week, as the paper price was pulling back from recent highs. 18 million ounces flowing into silver ETFs in 1 week. Total holdings are currently sitting at around 834 million ounces, which is lower than the 864 million at the start of the year. So yes, the overall level of ETF holdings is below where it was. That's real. But the direction of flow in the most recent week, money moving into silver ETFs while the paper price was declining, is equally real and worth examining closely. ETF flows in the precious metal space tend to reflect the behavior of larger, more sophisticated participants. When the price is falling and the paper market looks weak and research notes are talking about further downside, the people adding to ETF positions are not doing so because they lost their nerve. They are doing it because they have run their own analysis, reached their own conclusions about where value sits at current prices, and are acting on those conclusions. That doesn't make them infallible, but it does mean that the direction of informed money flow during this pullback is not consistent with a wholesale abandonment of the precious metals investment thesis. Now let's talk about the macro environment, because everything we've discussed happens inside a broader context that is genuinely complex right now. The first major macro factor is the geopolitical situation involving Iran. Recent days have seen a serious escalation into direct exchanges of military strikes involving multiple parties, and markets responded exactly as you would expect. Oil prices jumped. Equity markets sold off by 1 to 2 percentage points. Gold received a strong safe haven bid. and the other precious metals followed higher in the initial reaction. Some of this geopolitical risk had already been building into the gold price over preceding weeks, with gold gaining more than 10% during February alone. And yet, gold still spiked above $5,400 before pulling back to around $5,294. If the market had already fully priced in this specific outcome, you would not have seen that magnitude of additional move. The price would have barely reacted. Instead, it moved hundreds of dollars and then partially retraced. Gold holding above 5,200, even after the pullback, tells you the safe haven floor is real and firmly held right now. But here's what explains the gap between gold holding up and silver getting hit hard on the same day. Gold is purely monetary. It has no industrial application that drives meaningful demand. Nobody buys gold to put into a solar panel or a circuit board or a battery system. Gold's entire value proposition comes from its role as a store of wealth, a monetary hedge, a safe haven that has preserved value across centuries and across every form of financial disruption imaginable. When uncertainty rises sharply, money flows to certainty. And gold is one of the oldest, most proven forms of that certainty. Silver occupies a different category. Silver is a hybrid asset, and that hybrid nature is precisely why it struggles relative to gold during growth shock scenarios. Somewhere between 50 and 60% of annual global silver demand comes from industrial applications. Solar panel manufacturing is one of the fastest growing sources of silver consumption as the energy transition accelerates. Semiconductor manufacturing uses silver extensively. Electric vehicles rely on it in their electrical systems. This industrial demand base is enormous, and its structural growth trajectory is genuinely compelling over the long term. But it is sensitive to the global economic environment in a way that gold's monetary demand simply is not. When a geopolitical shock threatens global energy supply chains and manufacturing activity, the silver market feels that growth fear directly, not because industrial demand has actually collapsed overnight, but because the market is pricing in the risk that it could. This explains the divergence perfectly. Gold gets the safe haven bid, silver gets weighed down by growth anxiety. But here's what history shows across every major precious metals bull cycle. On record, silver ultimately outperforms gold on the way up, every single time. It lags during the early stages, underperforms during the corrections, and struggles when growth fears peak. Then, when the growth picture stabilizes and monetary demand and industrial demand align together, silver accelerates in a way gold simply cannot match. The gold to silver ratio is currently elevated because gold is holding while silver falls. Historically, an elevated ratio signals that silver is undervalued relative to gold. If the structural bull market thesis for precious metals remains intact, which the institutional research itself acknowledges, then the current ratio is telling you silver is effectively on sale relative to its historical relationship with gold. That is not a buy signal for today, but it is context that belongs in any serious analysis of where relative value sits right now. The trade policy and tariff situation is another macro factor, creating a specific and ongoing form of economic uncertainty that directly supports hard assets. A recent Supreme Court ruling found that the broad tariff framework being applied did not have the required legal foundation under the specific statutory authority being relied upon. The wider tariff architecture reshaping cost structures for American importers is now legally contested at the highest judicial level in the country. The administration responded almost immediately by invoking different legislation and reimposing blanket 10% tariffs, now in effect for 150 days while the administration determines how to proceed. For the next 5 months, the rules governing the cost of doing business for American companies relying on imported materials are genuinely unclear. When cost structures businesses built their operations around shift unexpectedly and trade relationships become contested and uncertain, investors historically move toward assets that don't depend on any particular legal or political framework for their value. Gold benefits from this kind of environment directly. And over the medium term, that dynamic tends to support the broader precious metal space. There is one more factor on the supply side not getting the attention it deserves, given how directly it affects the medium-term price outlook for gold. The world's largest gold mining company has just announced that planned changes to their mining operations will result in gold production falling by 600,000 ounces in 2026. They are projecting total output of 5.3 million ounces next year, down from the current pace. The longer-term plan targets a return to growth in 2027 as expansion projects come online in Ghana and Australia. But between now and that 2027 recovery, supply from the largest single gold producer in the world is contracting at a time when demand factors are pointing in the other direction. Basic economics says reduced supply meeting held or growing demand puts upward pressure on price. It may not show up in next week's price, but it is a structural tailwind present in the background across the entire horizon over which all of these other factors are playing out. And there is a policy development in China around market structure worth including in this picture. The Shanghai Gold Exchange recently cut margin requirements for silver positions from 27% to 24%, and also cut margin requirements for gold. Lower margin requirements reduce the cost of participating in these markets. More participants can access positions with less capital required. That increases liquidity and brings more active engagement. The direction of policy in China is explicitly toward making it easier, not harder, for capital to flow into precious metals. That signal runs in the same direction as the physical buying behavior, the tight supplier inventories, and the ETF inflows we've already discussed. Now let's talk about something that rarely gets enough honest discussion. And that is the question of who actually benefits when retail investors panic during a sharp sell-off. When silver drops 37% from its high and the narrative shifts from euphoric bullishness to genuine fear, a very predictable behavioral pattern emerges. People who bought near the top feel the urgency to stop the bleeding. People who bought lower but watched significant gains disappear feel the logic of locking in what's left. The emotional case for selling feels compelling, the future feels uncertain, and the internal voice says that if it fell this much already, maybe it keeps falling, and selling now feels like taking back control. But think about who is on the other side of that trade when you sell into fear. It is not another retail investor making the same panicked decision. The counterparty to a fear-driven sell order is almost always institutional, hedge funds with specific mandates to identify and buy dislocation events, market makers whose entire business model is built around providing liquidity when emotional selling creates a gap between where assets are trading and where fundamentals suggest they should be. Proprietary trading operations, running algorithms built specifically to exploit sentiment-driven dislocations. These participants carry data advantages you don't have. They carry risk management infrastructure that allows them to absorb volatility without the emotional response that forces early exits. And they have been waiting for exactly this environment to build positions at prices the broad market is too frightened to hold. This is not a conspiracy theory. This is simply how markets work. The process by which markets transfer resources from impatient to patient, from emotional to rational, from undercapitalized to well-capitalized, is as old as organized financial markets themselves. When you sell in fear-driven weakness, you are providing the liquidity that allows a better resourced, more patient counterparty to build a position at prices they wanted to see. Over time, the patient side of that trade tends to win more often than it loses. None of this means holding every position through every decline regardless of circumstances. If your original investment thesis has genuinely changed based on new information, that is a reason to sell. If your position size is generating stress that affects your judgment in ways that are not sustainable, that is a valid reason to reduce exposure. If you need the capital for something more important to your financial security, that is entirely legitimate. But if the primary driver of your inclination to sell is simply that the price is lower and lower prices feel frightening, that distinction is worth examining carefully before acting on it. The feeling of fear in a declining market and the analytical conclusion that selling is the correct decision are not the same thing. And the most consistently expensive mistakes in markets come from collapsing that distinction. So let's bring the full picture together. On the side, suggesting further downside ahead, the historical precedent is credible and not dismissible. The documented pattern of significant declines following extreme precious metals rallies spans multiple decades and multiple cycles. The 37% drop we have already seen is consistent with how those previous episodes began, not with how they ended. The institutional research is explicit that previous similar situations typically took months or years to reach the final bottom. The underperformance of silver relative to gold during the current recovery is a historically bearish near-term signal. All of that is real and deserves honest acknowledgement. On the side, means suggesting the structural case is intact, the physical market in China is actively absorbing this price decline. Suppliers are sitting on inventories tight enough that some are reluctant to sell at current prices. ETF inflows last week showed informed money treating weakness as an entry opportunity. The geopolitical environment supports gold and will eventually support silver when growth fears fade. Trade policy uncertainty supports hard assets broadly. The world's largest gold miner is reducing 2026 production. Chinese exchange policy is lowering barriers to precious metals participation. And the institutional research that issued the warning said explicitly that the fundamental reasons for owning these metals have not changed. All of that is also real and deserves honest acknowledgement. The resolution of these two narratives is not that one is right and the other is wrong. Both can be true at the same time. In the short term, the path may involve more pain as sentiment continues to reset and positioning continues to unwind. But the structural drivers that made precious metals one of the most compelling stories in global markets are still present. They have not been disconfirmed. They have been temporarily overwhelmed by the mechanics of a sentiment correction following an extreme move. When that process completes, however long it takes, Those same drivers will be there to power the next phase. What this means for you depends entirely on your time horizon and positioning. A short-term trader needs to respect the bearish momentum because fighting momentum with hope is not a trading strategy. A long-term investor with a multi-year view looks at a meaningful decline in assets with intact structural drivers and sees a different kind of opportunity. The universal error is trying to operate with a long-term fundamental thesis while making decisions with short-term emotional reactions. Get clear on which game you're actually playing. Position in a way that fits your real risk tolerance and time horizon. Then, stay disciplined enough to let the thesis play out rather than abandoning it at exactly the moment when patience is most required. I will continue tracking all of this as it develops. The situation in the Middle East is moving in real time. The legal and political landscape around trade policy will keep shifting. Physical premiums in Shanghai will keep providing real-world signal about where supply and demand are actually balancing. And ETF flows will keep showing whether the broader institutional community is treating weakness as an opportunity or as a reason to exit. That data matters. And as significant developments come through, I will be here to break them down. If this kind of analysis is useful to you, make sure you are subscribed to Element Access and notifications are on so you don't miss the next update when things move. Share this video if you know someone trying to think clearly about their metals position right now, and leave a comment below with where you stand. Are you holding through this volatility? Are you looking to add on weakness at specific levels? Are you sitting on the sidelines waiting for a clearer signal? I genuinely want to know where this community stands. Every comment, every like, every share helps this content reach more people who need real analysis instead of panic from mainstream headlines. Before we close, I want to say one thing directly to anyone sitting right now feeling the weight of a portfolio that is significantly below where it was a few weeks ago. That weight is real, and nobody should minimize it. The financial stress that comes from watching assets you believed in and worked hard to accumulate decline sharply is genuine and difficult. What I would ask you to sit with is a single question. Has anything about your fundamental thesis actually changed? Or has the price changed? If the answer is that the price has changed but the thesis is intact, then what you're experiencing right now is not a reason to abandon the position. It is the part of long-term investing that separates the people who build real wealth over time from the people who buy high and sell low, not because they lack intelligence, but because the emotion of the moment overwhelmed the logic of the analysis at the critical decision point. You now have the information. You have the context. You have both sides of the picture laid out in front of you. What you do with it is your decision. Make it from the data.